Less than an hour and a half a day, and in a month my result exceeded $9,000. And all this before the start of my main working day, because most of the time I devote to teaching other traders. And now I will show you the exact routine and strategy I use every day to get consistent results. And you can easily adapt it to your schedule. The most important thing for a trader who combines trading with work is to find a mode that really works for him. It's morning for me. I trade when the US market opens from 6:30 a.m. to 8 a.m. my time. This is the strongest movement of the day, high liquidity and clear impulses. I don't need to spend time on long preparations or pre-market analysis. I just sit down at the computer, look at the chart, and enter the deal. If 5 simple conditions from my checklist are met, which I will show in this video. The essence of my approach is to make trading a part of life, not to end up chasing charts. 30 to 90 minutes a day, and you are free. This is a system that does not require guesswork and complex analytics, but brings results. In this video, we will analyze what are the best markets to trade, what patterns really work, how exactly I enter into agreements, and how I accompany them to the result. If you don't have time to sit in front of the monitor all day long, this video is definitely for you. Let's get started. Trading flexibility. Most beginners don't even know that trading is flexible. The deal can last a minute or several days. Everything depends on your approach. Let's first understand what time frames are. A time frame is a period of time that shows how long it took one candle or one bar on the chart. Each trading platform has time frame values. You can see them right here on the Trading View chart example. So they consist of small time frames. I mean, for example, 1 minute, 5 minutes, 15 minutes. There can also be hourly time frames. 1 hour, 4 hours are the most popular, and then you can track the chart during the day, how the price changed during the week and during the month. Let's clearly understand what a time frame is. That is, looking at the chart now and opening a 5-minute time frame. What does the 5-minute time frame mean? This means that each candle during its formation, from the moment of its opening, open and closing, close, its formation time was 5 minutes. That is, in a 5-minute time frame, each candle is formed for 5 minutes. If we take, for example, a 1-hour time frame, to finally understand all this, every candle, for example, like this one, opened in this location, open, closed at this location, close. It also took 1 hour to form. Speaking specifically for this candle, we can even point and see that it opened at 5 in the morning and closed here at 6 in the morning, after which the next candle immediately appeared. I think that's clear. Each candle, regardless of the older time frame, contains a series of smaller candles. What do I mean? For example, let's open a 5-minute chart. Yes, we have a lot of 5-minute candles in front of us. Let's take this point as an example. What does this point signal to us? Yes, this point signals to us that the opening of this candle took place at 9 in the morning. That is, this candle was opened at 9 o'clock, here in this place. Here it is. That is, I will move the cursor once more so that you understand it all. Let's mark the area here, and it closed. For example, let's take 10 o'clock. This will be the given place. This is where this candle closed. That is, this entire range, starting from this place and ending at this place, was formed within an hour of time. That is, 1 hour from 9 to 10. Thus, the chart looks on a 5-minute time frame. I mean, that's how many candles there were, formed within 1 hour. However, if we open the hourly time frame, we will see that on the hourly time frame chart, it will all look like just one candle. That is, this one. Where did it open? In these values. And it closed already in these values. That is, here is the shift with this candle. I think that's clear. What do time frames give us, and what is this information for in terms of minute time frames? So, a minute, 5 minutes, 15 minutes. the most popular ones that we currently know. Here they are depicted, that is, starting from here and ending here. These time frames are used for scalping trading, that is, for trading in a short interval, or for a more detailed analysis of the moment of entry. I mean, to deal with the moment of entry, but not analysis of market behavior. In the long-term perspective, in terms of hourly time frames, that is, starting from 1 hour and ending with the most popular 4-hour time frame. What are we looking at in these graphs, and what type of trade are they suitable for? They are suitable for intraday trading, so trading throughout the day, where you can, for example, already see a clear market structure on an hourly time frame, that is, in which direction it moves, in the increasing direction. This picture is quite clear. That is, there are not many candles, not as much noise as on smaller time frames, and here you can already build trading ideas for yourself during the day and implement long-term positions. So, not positions that will be practiced for an hour or two, and here is the position where you opened at the beginning of the day, here and close, for example, here. As for daily time frames, they are not suitable for trading, but ideal for analysis. After all, here we can understand what happened during the previous day, what type was this candle closed, and what it informs about itself. And due to this, build further thoughts about where the market will move at the next day's open. Like this. Let's take this moment as an example to make it more interesting. Our market is moving in a long-term trend. It gets a pullback here. The pullback becomes ineffective for the day value. An absorption pattern is formed here. That is, the green candle is larger in body than the last red candle. Then we can already on the next day, after the absorption pattern is formed, take positions in the long direction. However, we will not open them on the daytime time frame, and we will switch to an hourly time frame, to a 15-minute time frame. And there you can build long-term ideas. That is, our trading decisions will be reinforced from the older time frame to the younger one. I think that's clear. Time frame is a very valuable tool, and I recommend learning how to use it. 3 approaches to trading. There are 3 main ways to trade: by alerts, delayed orders, or actively near the schedule. I will show how they differ and which one is right for you. So let's start with the first one. This is alert trading. What is an alert? Alert is a notification level. That is, for example, we have this price high that was formed right here. The market is currently here. I, for example, am ready to make some trading decisions only when the price reaches this level. That is, when it grows to this level. Only then will I be ready to make some decisions. However, I don't want to sit at the schedule and watch now. Will the price reach this level right now? Will it take, for example, 3 hours? In that case, I just take the line, put it here. I stretch and click on the clock. That is, this mark is called alert. Add alert. Here is the inscription. Add alert and set. For example, when the price reaches this level, click Create. What does this mean? When the price reaches this level, on which I will be ready, for example, to exercise some positions, I will receive a notification here in the app and in the app on my phone. That way I cannot get old in front of graphs all day, and simply, when the SMS arrives, I will connect to the trading platform and make a certain trading decision. I think that's clear. In terms of trading pending orders, a similar situation to this one. But let's talk in more detail. For example, we still have this price level. And I expect that when the price reaches this price level, we'll immediately push off in the short direction. That is, I believe that this price level is a resistance level for buyers. Accordingly, I want to accept short positions from this level, but I don't want to sit in front of graphs now 2 to 3 hours and watch when it comes here. In this case, not to release this position and not to waste time just mindlessly looking at graphics, I can use pending order trading. What does it mean? This means that, for example, I define my entry point for myself. For example, here, on TradingView, I am making a stop-loss production. That is, I am setting the entry point. For example, it would be 1.15716, but this is our entry point. Then, for example, pocket option. Let's take a look. I am switching to the pocket option trading platform. What do I need here? I need to choose a currency pair. For example, it would be euros, dollars. We choose it, like I analyzed, and then we go to pending orders. This is where they are. On this platform, we can implement the position according to the time. That is, for the position, for example, to be fulfilled in 60 minutes, or by quotations. That is, according to the price values. Select this tab. This is where it is with us, by price values. And we enter data from our trading view here. I mean, what level is it? This is the level of 1.15732. Going to the trading platform, let's write here, 1.15732. Select the payout percentage. That is, for example, if when the price approaches this price level, payout percentage will be lower than 60%. Alert will not work. That is, the deferred order will not work. However, if it is higher than 60%, the return on this asset, it will work. And then we choose the execution time, which we will put on the deal. For example, 20 minutes and a position size of $300. That's it. Click Sell. And we have our pending order displayed in this tab. That is, when the price reaches this price level, a short position will work for us. I think that's clear. Similarly, it works on graphics and on broker. The third trading style is trading right in front of the chart. That is, if we go in and open the trading platform and we are satisfied with how the price looks, for example, on the daily time frame, on the hourly time frame, we understand what trading decisions we can already make. That is, for example, here it is formed like this, dodgy right now, and we are ready to take short positions from here. Then this style of trading is called pre-chart trading. When we don't need to wait for any specific quotes or specific price values, either here or here, we are ready to take a position from this location. Therefore, we simply review the time frames, analyze whether everything suits us, and implement the position directly from these values. This is the most common type of trading among beginners. That is, they constantly like to look at graphs and take trade positions from anywhere on the chart. If you are a connoisseur of active trading or just starting out in trading, I want to invite you to my Telegram channel. At least 2 to 3 trading sessions are held every day in this trading group, where I share trading tips, signals, tell why I made such trading decisions. This is a community of like-minded people where we organically grow as traders. Each of the traders shares their trading achievements, and together we earn from it. Less time, more results. The less you trade, the better the focus and stability. 60 to 90 minutes a day is more effective than exhausting 6 hours in front of the screen. So each trading day is divided into 3 trading sessions. It starts with the Asian trading session. This session is the least effective for trading, especially for beginners. Here are the most difficult moves, and it is the most difficult to trade. I usually just skip it. Then our London session comes into play. That is, players from London, from Europe enter the market. Central banks open and real trading begins. This trading session starts at 7 a.m. and ends at 12 p.m. This session is characterized by quite technical movements on which positions can be taken. After it, the New York session comes into play. That is, players from America, from New York, enter the game. Central banks also carry out trade operations, and this session is one of the most volatile. That is, here the opportunity to pick up good trend trading moves is the highest. So what do I recommend doing? I recommend focusing directly on the London trading session and the New York trading session. If we speak for the London trading session, it opens at 7 a.m. and the best time to sell positions is from 7 a.m. to 7:20 p.m. It is at this time that the market forms trend movements. This is how it is in this example. A London session opens at this location, and from the 7th to the 7:20, it moves according to the trend movement, where you can, in principle, open high probability deals. We also have a New York session. What time for the New York session is the most liquid and the most attractive for trading? As we know that at the opening of the New York session at 12 o'clock, we often have news from 12 o'clock to 1 o'clock. That is, certain news about the economy, the state of the country, and domestic and foreign policy are realized on the market. This time is highly volatile, and it is very difficult for traders to predict the future movement of the price. The price may be too active and knock out traders with stop losses. Therefore, I recommend skipping this time and making trading decisions directly from 1300 to 1340. That is, we are opening a New York session. We see sharp spikes in volatility here. At this moment, at this moment. After that, we have, let's move the cursor over the graph, the time of day. Right here, at this point. As we can see, after the implementation of the news, where the market moved up and down, we already have some trend movement that we have targeting the low of the Asian session, where in principle, liquidity was formed. This trading time is the most effective, because here we have no extraneous influences on the market in the form of news, and we can safely go to trade and trade it. Also in the New York session, there is another opportunity for trading. It is from 1430 to 1450. These are usually short positions for 20 minutes where we already have an existing trend that has emerged in the market, for example, short, and we can implement scalping positions for 20 to 40 minutes, for example, to continue the current trend. This is something that applies directly to trading sessions. My day starts in the evening. Successful trading begins not in the morning, but in the evening. Rest, planning, and quality sleep. Without concentration, there will be no result. So when the key moves in the market have already been made, the market has reached some certain values, I can prepare for the next trading day. How do I do it? For this, I keep my own trading journal. This is what it looks like. That is, you can do it either early in the morning, that is, before the opening of the main trading sessions, for example, London, or late in the evening, when the market has already formed the final prices for the current day. What am I doing here? First of all, this is an assessment of the economic situation. That is, what news is actually waiting for us during the next day, after which I am already building my own trading plan. I am looking at several assets at once, such as euros, US dollars, Canadian dollars, and so on. I build a scenario for each of these trading pairs. That is, I know that the previous day the price interacted with this liquid level, after which it received, for example, a long reaction. Like in this example, it interacted with a 4-hour ineffectiveness and got a long response. According to this, I am building a further trading plan. In this case, I was building a long-term trading plan to continue the movement, as we can see that buyers prevailed at the moment. So this is how I run through each asset and make a plan that I will implement over the next day. I also write down trading ideas. If some of the trading plans have already been formed and I am ready to execute the position, I will write how the position itself will be performed. That is, we had a disability of this minimum level, the price confirmed the short structure, breaking it again. Accordingly, I expect the price to decline and write it down as potential trade ideas, that is, in the trading plan. This way. What do I do first on the schedule? I always start by zooming out the graph. First, I see the picture as a whole, and only then I look for entry points. So I start my trading day preparation with the daily time frame. Accordingly, I open the daily chart here and start analyzing the market. As we can see, in this case, the market has been in a bullish trend for many days. That is, buyers prevail in the market. Accordingly, at today's opening, I understood that the market would continue to rise. This is what forms the daily time frame. Then I switch to smaller time frames. Hourly. This can either be a 4-hour time frame or, for example, it can be a 1-hour time frame. Let's take a 4-hour time frame as an example. Here we see where our market opened. Let's mark that point today. It was opened with us in this place, from this candle. Then we had a strong long candle on the 4-hour time frame. If we include the hourly time frame, here we could directly form our trading plan and how we will implement the position. That is, the market is opening here in this region. We have inefficiency here. Let's tag her. Here it is. After interacting with this inefficiency, the market received a long reaction. So buyers entered the game and began to dominate. We also see that a doji candle was formed in this inefficiency, which signaled to us that a long trend is starting to emerge. Thus, I already had a clear idea on the hourly time frame that the market is starting to rise. But how to understand exactly when to enter the game, when exactly to open a position? I use minute time frames for this. For example, let's switch to a 5-minute time frame. At this point, let me remind you, this is our hourly inefficiency from which we built our trading plan. We see the price come in for testing it. Then it receives a long reaction in this place. What to expect? It is necessary to wait for a break in the market structure in the long direction. This is where it happens at this point. That is, this is the last structural high on the 5-minute time frame, where our market was moving down. After that, buyers entered the game, bought back, forming this high. Short movement continued, but it could not be fixed below the current low, and the buyers got into the game again and started pushing the price up. Quite aggressive. After which we passed this level. With this candle, we broke the structure in the long direction, and we had a new fair value gap. Here it is on our 5-minute time frame. It was from this place that I could already implement long positions. As follows. Putting the entry point right here, pulling the stop loss at the last current low, and the take profit may already be there. For example, 1 to 2 is an idea, or by some specific price value. For example, to this maximum, which was formed in us right here. I think that's clear. This is the first thing I do when I look at the chart. My strategy is to catch reversals. I don't chase the number of deals, I look for a turning point and work only with it. As in this case, we have formed this maximum, to which today's price directly corresponded. That is, let's mark this level on the TradingView chart. This is where it was formed here. That is, this is the place where we had the manifestation of two narratives. That is, buyers bought before this place, after which sellers entered the game and began to demonstrate short volumes. Then our market went into a downward trend. Accordingly, we understand that this is our liquidity level. That is, a potential place from where the price can get a reaction. On this approach to this level, I already understood that I will execute sell orders here. After all, the price is growing quite aggressively, leaving behind inefficiencies that could potentially be involved in price. Thus, I planned for myself to trade from this level, and already at this level, I could calmly implement the position. This is in such a format where the city of stop loss became an actual high, and my goal would be the given fair value gap. So I don't have to trade all these moves. That happened in this period of time. I just had to wait for the interaction with the liquidity level and enter the position in the short direction. This is my strategy for catching a reversal. This is the first thing I do when I look at the chart. Why am I switching to a 1-minute chart? A small time frame gives more details and accuracy of input. This reduces risk and increases the quality of deals. That is, returning to this example, we approach the level of liquidity, from which I expected to receive counter interest. It means that the market will be directed to shorts. A reverse model will be created. However, it was quite difficult to implement this position on the hourly time frame because I had no definite confirmation. I always use the minute time frame for this. Let's switch to a 1-minute time frame. It is located here above, and we see that in this place, after interaction with our level of liquidity, here it is. We still had a relevant long trend. Sellers have entered the game and started selling. However, did it change the last relevant low? I mean, here's this one. The long trend was still relevant, after which we get a long movement again. I mean, this is how I understood. What if the priority level of liquidity is reached? It is not worth implementing positions, because the long market structure still prevails, after which we climbed the mountain again, removing liquidity from the current maximum. And they began to fall. That is, after withdrawing this liquidity, sellers have already entered the game, having formed this low, where we had a short movement. Here the buyers entered the game, started to buy back. This redemption did not result in an update previous maximum. So I understood that long positions begin to be weak, and already from this place, that is, this point, where we have it, in fact, breaking the market structure, and this is the last structural point. We have a hack going on here, and I can implement positions. In what format? That's right, from inefficiency, that is, from the fair value gap that was formed on the minute time frame here in this area. This is how I stretch the position grid in the short direction, where my stop moose will hide for the current latest high. So, here it is. and my take profit will be the last one current low here in this location. As we can see, the price is successful, reaches our take profit, and we earn with a risk of 1 to 3. 5 conditions for entry. I don't open deals on a whim. If 5 items from my checklist matched, I'm in. So, let's take an example of this situation. The first question, which I set for myself, are my emotions under control? That is, I must understand whether I am in a currently positive emotional state or whether nothing is pressing on me. If everything is fine and my mood is fine, I'm ready to start trading. The next thing I do is determine if the market is trending. In this case, we see that the market has been growing all this time. That is, it is moving in a long trend. Accordingly, there is a trend on the asset, and this can also be ticked. Next point, are we at the point of interest at the moment? If we take a specific situation where the price was right here, where I basically implemented the position that I showed myself in the Telegram group, whether the price was currently in the POI, so at the point of interest, yes, because it interacted at this very moment with this inefficiency, that is, with this 5-minute imbalance from which I expected to get a long-term reaction. The next question I ask myself is whether I have identified the next level of liquidity. Yes, at the moment. I determined the next level of liquidity, and this last relevant high served as it. Let's mark it on the graph. This is where it was at our place. And the last final question is whether the pattern or setting has been clearly formed. If that is also the case, I accept the position. But how to understand whether it is clearly formed, that is, we have an approach to our area of interest. This is the third point. We have the formation of an attitude, that is, a change in the market structure. In this place, in this high, which is, in principle, a confirmation setup. Does our position match the trend? Yes, do we have a goal? Yes, this way we stretch the grid and implement the position from the given place. This way. That's all you need. Simple 5 points to open your position. Looking for trend and pattern scrap. I'm waiting for the trend to break, and I'm looking for a clear formation. This gives you confidence to log in. So let's use pocket option as an example to find a situation where we are currently experiencing a change in the market trend and try to open a position. For example, let's go to assets and select EUR. CAD is not suitable for us. Let's find the option that will be the most relevant for us. Here is Euro, Pound, for example. The profit is 92%. Great. What do we see? We see that the market moved in a long trend. Then we formed this liquidity void. That is, this is where our sellers sold in a long trend. After that, merchants joined our group again, started to buy back, but could not update the previous maximum, which served as a signal at this point that the long-term market trend is already coming to an end. Then the price updates this minimum, thereby signaling to us the breaking of the market structure in the short direction. That is, sellers currently dominate the market. Let's now switch to, for example, a 5-minute time frame. And let's understand that we have patterns here. We see interaction with the given inefficiency of the 5-minute time frame that we currently have. After which the price gets a short push. We see an absorption pattern between these two candles where we have a green candle, clearly smaller than red, which is another confirmation for short positions. So I think we are ready to open from this spot for 1 minute in the short direction. Let's open a position. Let's switch to a 15-second time frame to better track her performance. Thus, with the help of a market break and a pattern, we found an actual position for ourselves, and we are already implementing it on the market. Let's wait for it to finish working out. Give a like if you enjoyed the video. Subscribe to the channel so you don't miss new uploads. Click the bell to get notified about new content. And our position is closed in profit. This is how, by hacking the market structure and patterns, we implemented a successful position and made money on the market. News is not my moment. I don't trade during the news. At this time, the market becomes chaotic. This is not part of my system. So let's go, for example, to an information site called Forex Factory, or any other source you can identify for yourself. And let's determine in general what we fear and what arises. Every day there is some news on the market for some specific currency pairs. We have the name of the currency pair and the time of implementation of this news. As new traders, we always avoid news with red influence. They are marked with a red folder. That is, we are looking at the time when this news will be implemented. Look at its nature of volatility. It is marked in red, so it is highly volatile. And at this time, we simply move away from the monitors and avoid trading, because it is extremely difficult to predict the market during news implementation. Here, for example, even a recent situation where we had a news release on the market at this place and at this place. As you can see, the market literally blew everything in two directions. That is, it is called the seek-and-destroy model. I mean, search and destruction. The market is not driven by algorithms at all. So I recommend you how beginners and even experienced traders should miss these moments in the market. The market often flushes down before a reversal. It is at this moment that I come in, when everyone else has already left. Let's find a similar situation on the example of graphics from Pocket Option. Here, for example, we have a long trend for an asset, right? We have a given maximum. Players from these levels were ready to continue long positions after interacting with this inefficiency. However, what do we see? We see a flash. Behind the words of speed, that is, this is the place where the price tried to push above the previous high of the asset. However, it could not take hold there, and it is characteristic of us with a large, long shadow, very similar to the doji pattern. Then we have the opportunity to implement short positions, since sellers have already entered their positions, and the market will now try to knock them out of the game. Let's open a short position for 1 minute. So that's growth. It was fake. That is, it was pure manipulation for the players who entered the position right here. Thus, the market will collect liquidity. Since we waited for this type of manipulation, we can safely implement the position in the short direction, and it, most likely, will work positively. Let's take a look. Let's open a 15-second time frame and see what happens. Give a like if you enjoyed the video. Subscribe to the channel so you don't miss new uploads. Click the bell to get notified about new content. There are a few seconds left until this position is completed. As we can see, the position is successfully closed in profit. So once again, what are we waiting for? We are waiting for some situations where we see, for example, the market moving in a long direction. Retail players, that is, ordinary traders, enter from this area for promotion. After that, the price seems to update the previous maximum, but does not close above it with a body, thereby creating a large candle called a sweep. That is, we simply withdrew this liquidity without continuation. This was a hint that it is possible to implement short positions, as we did. A signal is a candle, not an intuition. I can't guess. I am waiting for confirmation in the form of a strong candle, and only then I go in. Let's take an example to understand what a strong candle is. Let's open some graph. For example, it will be very nice example. For example, what are we seeing at this moment? Here we have the formation of an example of strong candles. That is, these are candles that actually form an absorption pattern. They often look like this. Let's find some graph where we can use it and implement it. And even better, monetize. Let's use GBP, CAD as an example. What do we have here? Nothing is clear here. Here we have a great example. Let's open a position, and then I'll describe it right now. We close the position in the long direction. What do we see here? We see a long-term market trend. We see the formation of a strong candle. That is, it is the formation of an absorption pattern, where the green candle absorbs the red one with its body. Where does it do it? In long-term ineffectiveness. In the long fair value gap of 1 minute. What is our goal? Given and given of this whole fractal. This is how we search. Strong confirmations, not some random places. A set of factors must coincide in order for us to open positions. Let's open a 15-second time frame. Let's see how it works. Our position is doing great at the moment. A few seconds left. I mean, again, what was the logic? The trend is long. Long position. From what place? From inefficiency. At the expense of what? Due to the absorption pattern. Everything came together. And what does it bring us? This brings us a positive result. with which I congratulate you. Thus, having collected all the factors above, you can open positions on Pocket Option. If you do not yet have a trading account with this broker, you can register using the link below. How do I manage a deal? I always know how much I can lose, and I calculate the volume by risk. Next is just maintenance and profit fixation. Speaking for Pocket Option, it's pretty simple here. You, for example, are ready to take a position and want to risk 5% of your current deposit. Your balance is displayed here. To do this, you click on this tab. This way. This will automatically switch you to the interest calculator. That is, now your position is calculated as a percentage. Enter the 5 here. That is, 5% of your actual deposit. That will be $923. This is how you determine the size of your position and implement it. How about trading on a broker? For this, we need to find a position first. For example, we want to enter a long position from this location. And our stop loss will be at this point. Our stop loss will be 10 points. That's clear. How do we determine the risk and enter into the agreement? To begin with, open the Forex Trading Calculator. For example, it can be My Forex Book. Enter the amount of your current account balance here. I have $10,000. For example, risk per deal. For example, 5%. Stop loss in pips. Stop loss in pips. Again, you can see here, it is 10. Value 10. Go here and enter the value 10. Done. Click on the calculator. The size of our position will be 5 lots. Let's go to the broker. Open a pair. For example, Euro, USD, new order. Enter the lot size, which is 5. And click on the purchase. You can also set stop loss and take profit in these places. This is how to calculate your risk per trade and manage it. 2,300 in 90 minutes. Real result. Today's deals brought me $2,300, and I went about my business. This is my daily rhythm. But in reality, everything is level. The most important thing is to build the levels correctly. If you do it wrong, the strategy doesn't work. That is, a clear definition of liquidity levels and how the price will interact with them. This is the basis. If you haven't seen my video on support and resistance levels and liquidity levels, I advise him to reconsider in the description under this video or at this link. And finally, now give a short task. Open a demo or real account and make one deal according to the principles we have discussed. Build a level. Wait for input. Follow the checklist. Then write in the comments what you saw on the graph. Why did they enter? Where was the stop? And what was the result? We will show the best analysis in the next video. Practice is the key. See you soon.